Welcome everyone to our webinar on how to raise capital from overseas investors. My name is Sian McLachlan and I am a practice leader in LegalVision's corporate team. I'm joined today by James Swerling, who is a senior dealer at Ebury. Before we begin, a couple of quick housekeeping items. So you will be emailed the webinar recording and the slides after the presentation. So to the extent that you miss anything, you will be getting those after the presentation. Please submit your questions in the chat box during the presentation. We will be holding a short Q&A at the end of the presentation. So if you have any questions at all, please submit them in the chat box and we can answer them at the end. And finally, after the webinar, you will be asked to complete a short survey. Please put your details in here and provide us with any feedback about how you found the material today. Also, all attendees today are eligible to receive a free consultation with us to discuss how we can help you with your contracts or any of your legal needs. So to request your free consultation, please provide us with your contact details in the survey that appears at the end of the webinar. If you don't provide your contact details in there, we won't be able to contact you to provide you with that complimentary consultation. So today we will be discussing firstly the role of overseas investors in debt transactions, next overseas investors and their role in equity transactions. Following this, I'll be talking about some of the representations and undertakings an overseas investor might ask from you in your documents. Next, James will be talking about FX, and then finally we'll be talking about the insights investors might bring to your company. And then to finish things off, we'll be doing the short Q&A. So as I said, please submit your questions in the text box. So now I'll be talking about structuring your business for either debt raising or capital raising. So to raise money from investors, the best structure to do so is a company structure. So if you want to raise equity, you must use a company. You cannot issue shares in yourself if you are a sole trader. If you're borrowing money, a company gives you protection, because as a shareholder, your liability should be limited to the amount paid for your shares. So whether you're issuing equity or considering borrowing money, the best structure to do so is a company structure. So you might have a company already, and so that's a really good starting point. If you are going through particularly an equity raise, if you're raising capital, the best structure to do so is a dual company structure, as we've shown here on the diagram. So if you have a dual company structure, it's important to note that fundraising will happen at the holding company level. So if you operate across different countries or different jurisdictions, you'll be fundraising at your holding company level. That's where you'll either be issuing the shares or borrowing the money. Today's presentation focuses on businesses with a holding company in Australia. If your holding company is offshore, you need to get legal advice from lawyers in that country on the fundraising process. However, James's information today about the ways to manage your FX risk will still apply. Next, I'll be talking about the role of overseas investors in debt transactions. So in Australia, common forms of debt transactions include unsecured loans involving unsecured loan agreements, secured loans, safes, or convertible notes. So it's important to note that not all of these instruments or arrangements will have the same appeal to overseas investors. So that's part of the discussion that you need to be having with your overseas investor, is talking about the form that their investment will take. So if we look firstly to secured loans, a secured loan is a loan, so where you're borrowing money from the lender. And in addition to that, you're granting security over some or all of your assets to secure the loan. If you default under the loan, the lender can seize the assets and sell them and use the proceeds to repay themselves. If you're using an overseas lender, they might need assistance understanding Australian security law in these circumstances, because that's the relevant law that will apply for the assets in Australia. So even if the lender is overseas and you're using overseas-based documents, the security agreement generally will need to be an Australian law security agreement, and you'll need to get Australian lawyers to help you with that security agreement to ensure that it acts as it's supposed to in respect of your assets in Australia. Safes and convertible notes are very appealing debt instruments from a company's perspective, from a fundraising perspective. They're very flexible. We help our clients put these in place all the time, and they are can be very beneficial for companies, particularly if your valuation is not yet at a point where you want it to be and you're contemplating a capital raise down the track. A safe or a convertible note can be a very helpful way of raising money at this point in time. But it's important to note that for these instruments, they might have different registration requirements in different jurisdictions. So if you are raising money from an overseas investor and planning to use one of these instruments, that investor will likely need to get advice from their local lawyers about how those instruments will be treated in that jurisdiction, and if there's any specific requirements they need in the documentation. Next, are we talking about overseas investors in equity transactions? So equity transactions involve your company issuing shares to your investors. And so those investors become part owners of your company. So the capital raising process is structured very similarly in most jurisdictions, particularly in the US and the UK. So overseas investors should be very familiar with the process. The key question really will be what currency the raise will be in if you are using an overseas investor. So assuming the overseas investor wants to invest in their foreign currency alongside potentially investors who are investing in Australian dollars, you'll need to step one, agree the currency for the share price and therefore the valuation of your company. So this might be in Australian dollars, if that's what the majority of the investors want, or if your lead investor is dictating the terms, they might argue that the share price and valuation should be in the foreign currency. Step two is then to build a cap table using the appropriate currency. Step three is then for foreign investors, so assuming that you've built your cap table and agreed that it would be in Australian currency, but the foreign investor still wants to invest in their foreign currency, you'll need to agree an exchange rate for conversion of their investment into Australian dollars. So in deciding the rate, you might agree a predetermined rate. So you might look at the exchange rates as of today and put those into the documents. Or you might agree that you use, say, a 3, 4, or 5 day rolling average at the time of closing. So ideally, you would only be converting, the investors that are investing in foreign currency. However, I have assisted clients in building cap tables in both Australian dollars and the foreign currency. And so essentially, you have your cap table, two cap tables with two parallel sets of data based on an exchange rate. So that's certainly something that we can help you with if you need. The next thing to flag is if you are having an overseas investor involved in your cap raise is that certain Australian disclosure requirements won't apply to those foreign investors. So for example, foreign investors do not count towards the small scale offering exemption if you're trying to rely on that to not have to produce full disclosure documents to your investors, for example, not having to produce a PDS to give to the investors that are buying shares in your company. But if they are an offshore investor, they might need advice on the disclosure requirements in their jurisdiction. So for example, if they're a US investor, they might need advice as to how to ensure that their offering will comply with US securities laws. And so you need to ensure that they are getting that advice ahead of time and it's not going to hold up the equity raise. The last thing to note is that the ASIC register, so whether or not your raise is in Australian dollars or a foreign currency, the register has to be in Australian dollars. The register with ASIC has to be in Australian dollars. So even if your cap table is done in a foreign currency, when you notify ASIC of the raise and you're updating the ASIC register for your new shareholders, you'll need to convert their investment into AUD. So that's something to be mindful of. Next, I'll be talking about the representations and undertakings a foreign investor might ask for. So an offshore investor obviously has different considerations to an onshore investor, and this will affect your documents in that they might ask for different representations and undertakings to what is being asked for by your onshore investors. So firstly, one consideration that they'll have is withholding tax. So if you are borrowing money from an offshore investor, you'll need to consider interest withholding tax. So in Australia, the rate is usually 15%. And so what will happen is if you are paying interest on a loan to an overseas investor, when you pay interest to that overseas investor, you'll need to withhold an amount equal to 15% of the interest payment and remit that to the ATO. What an overseas investor might ask from you then is then to gross up the interest payment. So essentially to ensure that they get the full amount. And so what ends up happening is you end up paying 15% more interest if you agree to that gross up. So that's something to be mindful of. For shares, you'll need to be considering dividend withholding tax. So if you pay any dividends on the shares, those may be subject to 30% withholding tax, depending on where the investor is based and the type of investor. So that's something to consider. Next are the representations that they might ask you for. So they might ask you for representations that the company is not on any sanctions list and has complied with anti-bribery laws. So you need to be considering whether or not the company is able to give those representations to your investor. On loan transactions, the investor might require you to have in place a hedging mechanism, and James is going to go into more detail on this and the types of options that are available. But for example, they might ask you to include a reserve account, which you'll need to deposit money into depending on foreign exchange rate fluctuations. And that's to ensure that you have enough money in there to meet your interest or and principal repayments, no matter the movement in the foreign exchange rate. Alternatively, they might ask you to enter into a foreign exchange swap, in which you swap the payments in AUD for payments in the foreign exchange currency, and that comes with costs in implementation. And James will talk about that as an option as well. From your perspective, from the company's perspective, you might want a representation that the subscriber is not on any sanctions list and also has complied with all anti-bribery laws. And also we would recommend to our clients to ensure that they ask for a representation that the offer or issue of shares is permitted under the local laws of that investor. Next, I'm going to throw to James, who is going to talk about FX in equity transactions.
Thank you, Sian. Yeah, I guess there's a few different moving parts when it comes to the FX and cross-border payment components. So I'll just try and go through those in a step-by-step way. I guess the first really is actually mapping out the flow of the funds. Where are they coming from? Are they going to pass, say, from a feeder fund into another fund and then into your holding company? So again, mapping that out, understanding which jurisdictions the money will be crossing through and which entities you're going to be operating the money through. The reason for that is going on to step 2, which is the onboarding, the anti-money laundering and the legals. What you'll see from any anti-money laundering is that there's different regulations here in Australia than there are in other countries. I'd say AML is probably quite low touch in Australia, but in America, sanctions are just incredibly heavy on various jurisdictions and they're changing all the time. And compliance requirements in Europe are probably the heaviest in the world at the moment. And the documentation that they require for any cross-border transactions to be occurring and to have the accounts set up to make those happen, bank accounts, etc., are very, very high. So you want to really be very strongly organized on each of the entities that you are working with, where the funds are flowing through. Obviously, when you're structuring one of these deals, you're not doing that with anti-money laundering in mind. You're structuring it in terms of the way that your funds are going to flow, and then you want to be able to shoehorn that into this process. Step 3 would be a forward credit facility. That goes back towards what Sian was talking about a minute ago, that if this is a debt deal, that there would be the requirement to hedge back the principal and the coupon. The reason being that if the currency rate moves materially between the time that the funds are raised and the time that the repayment is there, you've got to ensure you've got enough money to make good on the full amount of the foreign currency that you're repaying, particularly if the Australian dollar depreciates in that time frame. So the way you would actually do that would be you could have some capital set aside for those FX movements, or alternatively, what you could do is enter into some foreign currency swaps. The reason you would have a credit facility is that ultimately you'd be entering those foreign currency swaps with a financial institution who would have counterparty risk on you. So ultimately, they're wanting to understand that those swaps can be fulfilled, that you'll be around in 5 years to fulfill them. So the credit facilities, that would be part of it. As the funds are transferred over, say from US dollars, you would immediately be entering into an equal and offsetting trade to purchase back those US dollars, to pay the coupon, to pay the principal later on. So that's why there would be credit involved. The other step you'd want to be doing is obtaining in-country bank accounts, in the country that you're raising the funds in. Ultimately, you want to be receiving the funds into the right entity name. The entity that you are, if you're an Australian business, you're not going to have an entity, say, in America or Japan, where you're raising those monies, but you do want to have an account in your name that can receive those funds very easily from where it is that you're raising the money from. So important that you get all of that set up. There is some documentation involved, again, part of that AML or anti-money laundering to do so. The other part would be getting to the pointy end is actually setting the FX rates. Once you actually have your cap table agreed, and once there is agreement on where the FX rate will be set, you're actually then booking that at market rate. So quite important that you work with a financial institution to understand the foreign exchange movements of the currency pair that you're going to end up dealing with, and to be able to set FX rates that are on favourable terms to yourselves, not just the other party where you're raising funds, or parties, sorry. And then point 6, I guess the most important part, deal and payment execution. You'll have got a lot of this, the foundations for this in place in onboarding in the right areas to have your accounts in place and to have your deals set up. But ultimately, you can't just ring up the bank on the day and say, we've got $500 million that needs to be converted from USD into Aussie. A lot of work does need to be done beforehand, hence the setting up of the accounts, the onboarding, the facilities, etc. And then really then the easy part is when it comes time to actually execute on the transaction for the funds to be received, to be converted, and then very swiftly moved across to where they need to be for deployment. But then that's all done very easily and the funds are flowing across very quickly. So point 6 becomes the easier part, as long as the other 5 steps, particularly 1 and 2, are done right at the outset. Moving on. In terms of the actual loan transaction and hedging mechanism, you do want to consider the cost of capital. One of the things that we see at the moment is Japanese investors have a very strong appetite to invest in Australia, but on the whole, a lot don't have much confidence in the strength of the Australian dollar over the next 3 to 5 years, mainly because Aussie yen is at the higher level of the trading range that it's traditionally traded at. The actual cost of that, though, in Japan, although money is cheap because interest rates are very low, that, though, does affect the returns on a swap when you're repurchasing the Japanese yen, say, for 5 years' time. The cost of hedging that Japanese yen repurchase in 1 year would be 4%. So ultimately, if you're going to completely cover the cost of your currency movement, you'd be paying something close to 20% if you're going to do that over a 5-year period, which is a very important thing to consider. Conversely, when the money's coming from America, Aussie US at the moment is probably towards the lower end of the trading range it typically trades in, but interest rates in America are higher than our own. So if you were then going to be hedging back the US dollars and looking to repurchase that in 5 years' time, the exchange rate that you're receiving for 5 years' time would actually be higher right now than the prevailing spot rate. So you're looking there at the interest rate cost versus the cost or the opportunity cost lost of hedging or not hedging, the market risk that you're going to be prone to. A little bit more detail on the hedging credit facility for etc. It's quite important in terms of the actual vehicle type that you're working with. A hedge fund, for example, would find it easier due to track record. On the other side, though, a company with not too much track record will find it a little more tricky to get that credit facility in place, just because obviously there's a lower credit worthiness seen. The quantum is very important as well. How much is being raised? How much is actually going to be deployed into a hedge? Time as well. Whichever financial institution you are hedging with, if you're doing it over 1 year, it's significantly less risk to them if you're hedging for a year as opposed to if you're doing it for 5. I guess most importantly is risk appetite, and that comes down to yourselves, which is, do we want foreign exchange market movements to adversely affect what's going on here? So you might have absolutely zero risk appetite, in which case you say, well, we're going to completely hedge everything. Or there might be a high risk appetite. You might say, well, we're going to hedge a portion, or we might hedge using foreign exchange options as opposed to just a more vanilla swap. And then it's a case of just having a hedging program implemented, which you'd want to do with your financial institution. And finally, on a smaller scale, you'd want to have escrow accounts, essentially where you can have those funds set aside if you are just leaving some capital on the side to mitigate for foreign exchange movements. You need an escrow account for that to sit in and to earn some interest in as well. Back to Sian.
Thanks, James. Lastly, we'll talk about some of the insights investors might bring. So an overseas investor, if they're from a more developed market, for example, the US or somewhere in Europe, they can bring valuable insights about the performance of competitors. And these, the performance of those competitors can help set an example for how you might want to conduct your business, for example, strategies to acquire customers or how to manage costs. Next, if the investor is from a similar industry, they might open up pathways to partnership and expansion opportunities. Or if not that investor, they might be able to introduce you to people as well that you might be able to partner with overseas. Next, they can also provide insight into how products or services perform in different market conditions. So, the Australian economy does not perform exactly the same as economies overseas and is not currently in the same position as those different markets. So, you can get an insight into how your product or service might perform either in worse conditions or slightly improved conditions. And then that can hopefully give you some strategies to set the company up so that it can be flexible depending on what happens. Lastly, if you are considering expanding overseas, and an overseas investor can be a great step in the door. So they might be able to introduce you to distributors in that market, or connect you with marketing companies in that industry, in that environment, to ensure that you have a successful launch in that market as well. So that concludes the main part of our webinar. You might find our Startup Equity Toolkit useful. You can access this through the handout section in your webinar panel, or by scanning the QR code on the screen. We also have an upcoming event that may be of interest to you, how to successfully complete your business sale, which is on Thursday, the 8th of June at 11 AM Australian Eastern Standard Time. You can register for that webinar through the link on the screen. So we're going to answer your questions very shortly. So if you have any, please submit them in the chat box. We've had a few come through already, so thank you for those. While you submit them, we'll take a minute to tell you about LegalVision's membership. So LegalVision's membership is a cost-effective alternative to the expensive hourly rates you experience with other law firms. For an affordable monthly fee, you receive cost certainty and all-inclusive legal services, including unlimited document review, including drafting, amending, and reviewing business contracts and commercial leases. It also includes unlimited advice consultations with our team of 100+ specialist lawyers, including business structuring, employment disputes, and more, and unlimited domestic trademark registration. As a LegalVision member, you won't worry about the cost of lawyers ever again. Think of it as having your own in-house counsel. We'll take care of all the business as usual legal work so you can focus on running your business. And if you are in-house counsel, our membership is a cost-effective solution for outsourcing additional legal work. To learn more about how the membership can help you, please request a free consultation when the survey appears at the end of this webinar. And now, while continuing to submit your questions, James will tell you about the services that Ebury offer.
Thanks, Sian. Yeah, so Ebury is a fintech, but also a financial institution dealing with foreign exchange and lending. We work in the majority of countries in Europe, as well as in APAC and South America. With a global team, we can provide foreign currency accounts in any area of jurisdiction that's required. And we also have FX experts, myself included, that will help you navigate through any of the foreign currency risk mitigation that you require. In addition to that, an actual payments platform that works in real time, instant payments, and so forth. So thank you for the opportunity to give us a brief run through of what we do. We can provide a bit more detail if you're interested.
Great, thank you, James. And now we will answer some of the questions that have come through. So the first question we have is, how can startups navigate or work around the requirements for a local entity in the country of an investor? So as I kind of highlighted at the beginning, if you are going through the fundraising process, that fundraising will occur where your holding company is based. And so primarily for the fundraising, whether that be debt or equity, you'll be focused on the holding company in Australia and dealing with the laws in that jurisdiction. However, if your company does have offshore subsidiaries, they might become involved through the process. For example, as I said, if you're granting security over the assets of that entity, or if the investor was wanting to conduct, if you're doing an equity raise and the investor wants to conduct due diligence on those entities. And so if that is the case, you might need to engage lawyers in that local jurisdiction just to ensure that you can get the relevant documents in place for that entity, or answer any of the due diligence questions that might come through in respect to that entity. But yeah, so you'll have to just think of that and be managing those legal costs when you approach the transaction. The next question is, can you please advise how FIRB regulations apply to this? So FIRB regulations, for those that don't know, so to the extent that you are having a foreign person, and that's a defined term in the regulations, but in summary, it's usually a company that has at least 20% foreign ownership, or one individual holding 20%, or a number of individuals together holding 40% of foreign individuals. Then that company might be a foreign person, and if they invest in your company, then you might need to get FIRB approval before that investment can take place. I would just flag that in our experience, particularly if you're a startup or a small business, you're unlikely to trigger the FIRB thresholds, which are very high. So, for example, for non-land investments, unless you're from certain countries, the trigger, like the lowest triggers are, if you're a business other than an agribusiness, the threshold is 310 million. So if the company is worth that, so the company that the investment is coming into is worth more than 310 million, then you might need to obtain FIRB approval. Or if you're in an agribusiness, the threshold is 67 million, unless you're from specific countries. So generally, FIRB approval is not required unless you're a very, very large company. The only exception to that being if the investor is a foreign government investor. And certainly we've seen from our clients' perspective, some certain funds from certain countries do qualify as foreign government investors. And if that is the case, then the threshold is 0. So if you have that type of investor investing in your company, you will need to get FIRB approval before they can invest. I would just note that FIRB approval is an obligation of the investor to get, but obviously if they don't get that approval, then they may not be able to invest and it may hold up the raise. So it's important to be having those conversations up front, and it's important in your documents to have the fundraising subject to any approvals that are required from any government entities. Next, we have a question: is there any difference in fundraising tactics for startups? James, do you have any thoughts on this one?
Yeah, on the foreign exchange side, a startup would find it probably a little bit more difficult to get the credit facility that's required for very long-term hedging, just on the basis that there isn't necessarily that track record, and that essentially just slightly reduces the risk appetite of some financial institutions to actually provide long-term hedging facilities. So it's something to consider, but obviously there are ways to make that work with the right kind of documentation and presentation.
Yeah, and I would say, yeah, outside of the FX front, that's something that is true for startups more broadly, is that, yeah, because it is an earlier stage company, it's obviously high risk from an investor perspective, and so in terms of the investors you're looking at, there's only certain groups of investors that are willing to invest in startups. So usually for the first few rounds it might be friends and family, then you might move on to an angel round, and then VC investors. So those types of people who are experienced in dealing with startups. So that would be my suggestion in terms of tactics, is making sure that you're approaching the right people, because those are the people who are experienced with companies in those positions, particularly if you're pre-revenue, and so they have a better idea in terms of what's an appropriate valuation for your company in those circumstances. The next question is, how long does it take from start of the deal to payment execution? How does it vary between overseas investors versus local investors? And what is it like in the current market? So I'll talk about this from an equity perspective. So from the start of the deal to payment execution, once you find your investors, so the finding of the investors can often be the longest part, so it can take a very, very long time. So we encourage our clients to be having those discussions with investors as early as possible. But once you've found your investor, as guidance, it does generally take between 3 and 6 months. And that involves, negotiating your term sheet, conducting due diligence, negotiating the documents, and finally doing completion and all of the completion steps. So if you are thinking about fundraising, I encourage you to make sure that you have enough runway in there, at least 6 months before you need that money in the door, and that will ensure that you can conduct the process in an efficient but calm manner as well, and making sure that you don't have your back against the wall and have to accept terms that you wouldn't otherwise would. Even with overseas investors, that time frame still stays broadly the same. There's not too much change to the transaction, as I've said, other than some additional representations and undertakings you might put in place. And James, you can provide some insights in your experience in how long it takes for a debt deal.
Yeah, I think for a debt deal, similar time frame in terms of the actual raising side of things. However, what I would also say is, because of the fact that you need to think about the repatriation of funds at the end of the term, you want to also consider, from the point of view that it's looking likely, how you will be managing that market risk if it is to be overseas currency repayment. That is, a couple of month-long process in terms of actually working out the risk mitigation side of things, but then also just actually having all of the facilities in place for your cross-border payments, for your conversion, for receiving funds, etc. So you almost want to be thinking about that as soon as a realistic deal is on the table for you.
And we've had a follow-up question on FIRB. So my understanding is FIRB can be treated if you work with defence or work in certain industries. Yes, you're correct to those thresholds I said before. There are additional thresholds for certain industries. So specifically national security businesses or Australian media businesses also have a threshold of $0. So if your company is in one of those industries and you're taking any investment, then you'll be required to get FIRB approval. I would flag the FIRB regulations can be quite complex. So if you do have any concerns, please speak to your lawyer who can provide you with guidance as to whether or not there may be a FIRB concern with your transaction, and whether or not you're required to notify FIRB and provide you with guidance on how to carry out that process. Perfect. So I think that's all the questions for now. So thank you so much for joining us. As I said, after the webinar ends, a survey will pop up. We would really appreciate it if you could complete the 30-second survey. And don't forget, please include your contact details to receive a complimentary legal consultation to discuss how we can help you with your capital raise. And thank you so much for joining us.